welcome to today's podcast. Today I'm talking with Harry Knight from Corbett Keeling. Corbett Keeling are corporate finance brokers, and they'll work with you when the time comes and the time's right for you to actually exit your business and you want to make that transition or the sale. So we've worked with these guys, we like their style, they've got a good approach and they've got a good track record, which is what sets them apart. So I won't steal any of Harry's thunder, I'll just get Harry to introduce himself from here. Harry, welcome to the podcast.
Thanks, Daryl. Yeah, so I'm Harry Knight. I'm a director in the team here at Corbett Keeling. Bit of history about me. I was previously at EY doing transactions there. Worked on some large transactions, Vodafone Verizon deal, which was $100 billion plus, which were good for the CV, but I didn't really enjoy them as much as the owner-managed entrepreneurial type businesses. So we covered the whole spectrum at EY. I loved working with entrepreneurs. Jumped at the chance to join Corbett Keeling, getting on for 6 years or so ago now. Corbett Keeling is a boutique corporate finance advisor specialising only in advising owner-managed businesses, entrepreneurial type businesses, on exiting their business. We've been around for 30 years. It's what we love doing, and I guess what we're most proud of when working with these types of businesses are completion rates, deal completion rate. When we kick off with a client who has made the big decision to sell their business, 95% of the time it results in a successful sale, which personally is what I'm very proud of at Corbett Keeling. Making the decision to sell your business is huge, and probably the largest financial decision of your life. It's like selling your baby, people often say, and for it to actually happen rather than not is what we're all about at Corbett Keeling. And that's not at the expense of getting the right value. That's equally as important for us. And just sort of another stat on that is that we achieve 45% above our clients' expectations on value as well. So that's what we're all about at Corbett Keeling. When you make the decision to sell your business, we're here to make it the reality.
Okay. So, and 95%, that's a big claim, because I hear stories in the marketplace that, like only 40% of businesses actually get to sell. So I guess not all of those, 100% come to a corporate finance house, but those, that 95% success rate is, you must be doing something special.
Yes, it's something that I check every few months to make sure that it is still right, and it is. And yes, it is unusually high, and I guess probably the reason for that is that we understand that selling your business is a huge decision, and from our perspective, we try deliberately, and it sounds quite odd to say this, we deliberately try not to take on too many clients each year. So that the clients that we do work with, we give them 100% and stand shoulder to shoulder with them during the sale process and make sure that the deal actually happens.
Okay, so let's dig into the detail a bit. So, we've got, I'm sure the listeners have got a lot of questions, especially if they haven't been through a sale process before. So let's start right off the back with, how long does it take? Once I've made the decision that I'm going to sell my business, I come to a corporate finance house like yourselves. How long does it take on average from when I start with you to I actually walk away into the sunset on a sandy beach for the rest of my life?
Yeah, very good question. It's and as ever, there's a range. We've worked with businesses and completed from start to finish. It was 2 months. There was some unusual circumstances around that transaction that it needed to be done quickly, and they had already been through an unsuccessful process before, so they were very sort of ready for it and had all the due diligence information ready. On the other end of the spectrum, crikey, sometimes 2 years, things crop out the woodwork, and it delays everything. So you can get a real range there. Probably what we say, if a business is well prepared, if it's got its ship in order, it's taken it's stopped, it's thought about it, taken a few months to do the steps that are needed to prepare the business in the lead up to a sale. If at that point you then start the sale process, kick it off, 6 months is what we say. And that's split, and that's split into 3 different sections. First 2 months is preparing the documentation. So that's preparing a business overview document, information memorandum, deciding which buyers to go out to, and approaching those buyers. That takes 2 months or so. The second 2-month period is meeting the buyers, telling them about your business, maybe a site visit, subject to confidentiality, and then soliciting offers from those bidders. And there's a bit of toing and froing, negotiations. You want to get a bit of competitive tension going between the different parties and a sort of auction type process going to get the highest, to get whatever you want out of the offer. Some people want highest price, other people want more certainty or what have you, or chemistry with the buyer. The last 2-month period is you've chosen your favorite, your preferred bidder, you've chosen your preferred offer, you go exclusive with them, one-on-one, they start their due diligence in detail, looking under the bonnet, and you draft the legal documentation, and that usually takes about 2 months, and then you sign on the dotted line.
So 2 months is best practice. You slipped something in there, which I'm sure caught the ears of a number of our listeners, that if a business is well prepared. So what is it that you see or you don't see that makes a business well prepared? Because sometimes I hear, talking to corporate finance people, that they go, well, businesses approach them and they just say, hey, look, you're not ready yet. You need to go away and get prepared, get ready for exit, and then come back to us. What is it that you guys see that makes a business or suggests to you that they're not ready? Or there's just too much work to be done yet.
Yeah, well, it could be all sorts of things. On the one hand is, have you got the information? Have you got your ship in order on the sort of administrative side of things? On the legal side of things, is everything in one company, or is it spread across different companies? That will make it less attractive to a buyer if it's spread across 5 different companies. Or and probably the single most important factor when working out whether a business is ready for a sale or not is have you got a management team who is running the business? If you're, depending on what your objectives are as a seller, but if you're selling your business and looking to transition out of the business, the single most important point that delays being ready for a sale process is having that team in who can run the business, without you, really. And very difficult to do that. Darryl, I'm sure you've seen it time and again. It's very difficult to do that. But from a buyer's perspective, what they're looking to do is to buy the business. And if you're looking to walk away, they need to know that it can run without you. I don't know, Darryl, interested to hear from you. What sort of things do you see?
Well, exactly that. Do they have their shareholder agreements? Do they have a number of shareholders in the business? Is the sort of things that we want to tidy up? The shareholder agreements. A big one is can the business run without the business owners? Is one of the things. Getting them succession ready or exit ready. Do we get them out of their operational role so that they're just playing a strategic role in the business? Do they have systems and processes in place so that it's not reliant on key staff, or it's less reliant on key staff, but more about training people to follow the systems and processes? How turnkey is it? They're all, do they have a brand and position in the market? Do they have IP or proprietary product and processes? They're all the things that we look at. And obviously, I think the thing that you touched on is the reliability of predicted income, future income. Is how risky is that? Is it all contracted? Do we have a pattern of increasing income over the years? They're the sort of things that we want to put in place and clean up their financial statements so that the salaries, the incomes, they're all clean, and tidy, and the expenses and the costs of running the business are a true indication of the business financials.
Yeah. And the other thing that we often see is if a business owner has got a number in mind for their business, um, and that's the condition of the sale. Speak to people like us. We can give you a true valuation of your business, and often, you know, if it's not reaching that number, then we say to maximize the value of your business, spend another year, you know, add a different service or product line, do that extra bit of growth, and then you'll be the size and the scale that will deliver the number that you're looking for.
Yep. So you must see a lot of businesses, and often you see you have some experience of selling businesses in the same industry, and sometimes you'll see them go for much higher multiples than others. In your experience, what are you guys seeing that influence a business achieving a higher multiple than what you might call the standard?
Yeah, vitally important point. And there's probably over 100 different factors that go into that buyers consider, either sort of consciously or subconsciously in their head when they're valuing a business. We whittled it down to 80 in part of the exercises that we do when we kick off with a business, but I'm sure it's more than 100. And the single greatest factor is what we call the quality of the future income of the business. And things that they'll be looking at there is how repeatable is the income? Is it contracted? Brilliant. Is it on a subscription basis? Brilliant. How risky is? How much risk is there on future income coming in? Is there, say, 3/4 of the revenue from one particular client? If there is, then a buyer will perceive that as a risk and will price accordingly. So, and of course, the other factor is the sort of growth of the market in general. So some of the sort of tech businesses which are on subscription basis in a fast-growing industry tend to be higher multiples. Other industries where it's more sort of where the revenue is more one-off in nature, is perhaps discounted more heavily from a buyer's perspective. Ultimately, what a buyer is doing is they're buying the business for the future cash that it will generate under their ownership. So the more certain they are about the values of the cash generation in the future, in all likelihood, the higher the price or the higher the multiple.
Yeah. I think one person described it to me really well once, and I just remembered it, and they said, Daryl, a business is just another investment. And because it's an investment, it's something in my portfolio, I need to assess it from a risk. It's a higher risk, so I'm expecting a higher return. Because if I don't spend the money on the business, I can invest it in property, I can invest it in the market, I can invest it in bonds. I need to look at it from an investment perspective. What's the risk and what's the return? If the lower the risk, the higher I'll pay.
Mm-hmm.
And so I thought, yeah, look, that's the way to look at it, isn't it? So you've got businesses coming to you. What do you guys work in any particular industries? And do you notice any differences across industries?
Yeah, we're not sector specialists. We work across all different sectors. I'm personally a generalist. The way Corporate Keeling's model works is that we have sort of M&A transaction people in our core team, and then we've got a number of sector specialists who work with us on particular deals in particular industries. And these are senior people who are immersed in the industry and they know it inside out. They from a seller's perspective, they really understand how to present the business in an information memorandum. So they're immersed in it, and also because they live and breathe the industry that they're in, pharmaceuticals or construction, what have you. They've got their ear to the ground and they know who's looking to acquire businesses, who's got money, what their strategic objectives are. So they open up a sort of pool of buyers that perhaps you wouldn't normally expect. So we see them as hugely valuable to our service offering to our clients and getting the optimal transaction for our business owner clients.
Okay, so that's your secret then. You've got your in-house generalists, and depending on the business, the client you're working with, you've got a team of specialists who are associates with
Yeah,
Corbett Keeling, and they bring the industry-specific knowledge. Interesting
yeah,
stuff.
yeah.
Okay, so what about when it comes to the buyer, Harry? We've got all sorts of different buyers out there. How do we know if it's best to sell as a trade sale, or is there someone out there who would be willing to pay, would see your business more valuable to them and pay a higher multiple, pay a higher price than a trade sale? What are the options out there for buyers or sellers?
Absolutely. If you want to maximize whatever you want out of a transaction, some people want value, some people want certainty that it will happen. The best way to do that is to go as wide as possible and have as much selection of offers in front of you. Trade can often bid highest because they might have synergies with your business, which sort of might double the profits from their perspective. So when they're applying an industry sort of standard multiple to it, the value is almost double. So trade can often pay higher. But that said, private equity, which is another option, tend to sort of leverage their acquisitions more highly, and debt is so cheap at the moment. It means that they can often get to a higher number than trade. It's not fair to say one always pays higher than the other. We've been going for 30 years, and we've looked back at what percent of our transactions go to trade, what goes to private equity, and generally speaking, that's because one of them is bidded probably higher. It's pretty much 50-50. I think it was 60-40 in favour of trade. So you've got a range in front of you, and of course there's other options that business owners can consider. It's if there's a management team who are already running the business and they've helped grow it, and they're there and they want to be business owners, often a sale to a management team can be a really an all-round a very good option. There's continued legacy gets continued. You in some ways reward the employees. There's a good chance that type of transaction will be successful because there's no third-party buyer coming in. So a lot of business owners like that. I guess the thing to weigh off against that is how important is it to get all of your cash outs up front at the time of the transaction. You sell to your management team, the chances are then that there will be a significant amount of the consideration deferred over, say, 5 years or so. And the other increasingly common sale option is a sale to an employee ownership trust, which were introduced in 2014, and year on year they become, well, there's more and more employee ownership trust transactions.
Yeah, it's becoming employee ownership as a means is becoming a lot more popular. We're seeing that as well. It's a great way for, from what we see, of not only having an exit plan, but creating a better business along the way, of having everyone being rewarded and having incentives for the same thing. It lines everyone up. The outcomes are higher profitability, higher profits, productivity, I think I'm saying, and it's just a better business to be involved in because people are working for the same cause and they're aligned. Those that don't care tend to drop out because everyone's got an ownership mindset. We change the culture to an ownership mindset. They only want to have like-minded people in the business. So yeah, employee ownership is a great way forward from what we're seeing as well. So in your experience, we've got trade sales, we've got right through to private equity. I think you're saying it's almost split down the middle as to which way it goes. 60-40, 50-50. For business owners who've been running their business 10, 20, 30 years, it becomes a significant portion of their life, and I imagine it's quite a stressful period for them. Is there anything that you find that A, they can prepare better and appreciate and know that it just what is involved, or B, how do we just overcome the stress?
Yeah, it is. Well, it's so it's the biggest financial decision of most people's life, and then on the emotional side, it's almost like selling your baby. So time and again, it's like nothing else. You've got to have an advisor there alongside you, and it's preparation beforehand, which makes such a big difference. Businesses that are well prepared before they begin the process, it tends to take closer to the 6 months rather than the 2 years. And so if you have taken the steps to prepare the business in the lead up to the sale, then it runs more smoothly. It runs more smoothly, and it's less stressful. It's still stressful, highly stressful, especially during the due diligence phase, and when it comes to a conclusion. But the more you prepare, the closer you are to the 6 months, and the more smooth the transaction is.
So I think you're really bringing the message home. The better prepared a business, the less stressful it will be, the quicker it will be, and they'll achieve a higher price.
Mm-hmm. So absolutely. And having someone alongside you the whole way, who's been there, who's done it before, knows how to deal with these stressful situations, someone who can take the brunt of the emotionally charged conversations that happen with a buyer. They always do. But someone who's been there, done that before, and can advise you on how best to resolve the issues that always come up.
Yeah, so it's really that peace of mind and guiding you through that person who's done it before. Brilliant. Hey, what about the subject of earnouts? Is there anything that you guys see that can reduce the chance or the need for a long earnout period? Because from our side, one of the things that we see is a lot of business owners who have sold their business end up in an earnout period. And then leaving before that earnout period is completed and leaving money on the table. To me, that's something that's avoidable, and it's just so sad after it's a lifetime's work ends up like a messy divorce. From what you see, how can you what's your experience around earnouts and what have you?
Yeah. So I guess the question is, why would a buyer insist on an earnout?
Yeah.
And probably the reason why they would do that is because they have a degree of uncertainty about the future cash generation of the business. So to reduce the likelihood of a buyer wanting an earnout, or to reduce the quantum that is associated with an earnout, then it's about increasing the certainty from the buyer's perspective of the future cash generation of the business. So it's contract, wherever possible, getting a contract in place. Some industries, it's just not the norm. That's fine. But there's other ways of showing it. If you look back 20 years, has that customer bought from you every year for 20 years? If they have, well, there's probably a good chance that they will continue to do so for the next 20 years. So those are the types of reasons why a buyer might insist on an earnout. So there's perhaps bits and pieces that you can work with there. Where if as a seller you really do not like the idea of an earnout, then there's other ways of structuring transactions. It's perhaps the result is perhaps a slightly lower upfront cost, but at least you get it all upfront. But the other thing, it has to be said, some business owners love earnouts, and again, it just depends on how they're structured. Some business owners see so much potential for the future growth of the business. You think, the buyer's going to get it all. So we get some clients asking for earnouts, and I'm working on one at the moment. And it's rather than earnouts, they're calling it a profit share, future profit share. It's just
so structuring the earnout so that you're doing it on your terms, because you want to be there because you're helping the new owner achieve the new profit, as opposed to being on their terms where you have to be there because you're the only reason that the future income is likely to eventuate. So you're there to make sure that revenue comes in while that handover period occurs. So it's all about doing it on your terms rather than having the terms dictated to you.
Being creative with the structure, thinking what works for the buyer, what works for me, and something like that. If the size of the cake is growing, doubling over the next 3 years, everyone's happy. The buyer's happy, because they're still getting whatever, 3/4 or 50% of the profits. But you as the seller are still participating in the future growth of this business that you've built yourself.
Yeah. Okay. So look, hey, Harry, you've shared a whole lot of wisdom and knowledge there, and it's been amazing. Can I just ask one final question, just to tap in? It might put you on the spot a tap, but you've worked with business owners over a number of years to help them, exit their business. You've got a number of business owners from different industries and levels of experience. Is there one common theme that every time someone comes to you, you thought, look, I wish they'd already done this. I wish they'd had this in place. So a piece of advice that you can give to business owners before they approach someone like yourselves?
Oh, yeah, it's probably the way to achieve what you want, and it could be anything, but the way to achieve it is to work with an advisor and run a process, a controlled auction process, where you get as many different offers on the table, keep open all of the sale options for as long as you can stomach it. I get people coming in and saying, I will never sell to private equity. They're all sharks. I'm not going to sell to them. And I'm only going to sell to trade. And we try to sort of convince them, just meet one or two private equity. And they agree to do that. And then sometimes they think, oh, actually, you know what, private equity, they're not all sharks, because I'll tell you they're not. They keep the name of the business. There's no sort of problems with chemistry or different sort of ways of doing things that sometimes you get with trade. And they're pretty aligned with a lot of business owners, because what they want to do is grow the value of the business, just like a lot of business owners. And then on the other hand, you get people who say I will never sell to trade, I'll never sell to a competitor. But then actually, when it comes to it, it could be quite a nice home for your business. The buyer knows the industry. They might have things that they can bring to your employees if they become part of a larger organisation. There could be all sorts of sort of growth opportunities for your employees, so they can give things which private equity can't do. So and then the last one, selling to your management team. People often say, "Oh, my management team don't want to own the business. They're not that type of people." Then you get sort of, as the process develops, you get the managers coming to us and say, "Hey, I want to buy the business." So please try not to have any preconceived views about what you want to do. Keep as many options on the table as possible for as long as possible. And when you have the offers all in front of you, you can make the most informed decision that's best for you.
So prepare, put all of the fundamentals in place so that the business is working and it doesn't rely on you, but keep your options open.
Keep your options open.
And get good advice, I think is what you're saying. Hey, that's brilliant, Harry. Thanks for your time today. I appreciate you sharing your insights. I'm sure we'll speak again.
Yeah, thanks, Darryl. Speak soon. Bye-bye.